Supposed to say that. A fun fact, actually, you're not supposed to say that. North Carolina is a single party winning state. So if one person in a conversation knows it's being recorded, i.e. the guy recording it, nobody else has to know for it to be legal.
You scare me, Scott.
Yeah. Just a fun fact. Cool, guys. Well, I am super excited about this call. If you didn't gather from my email that I sent out. So we'll just kind of jump into it. Today we're going to talk about financing and lending with Patrick Stoy, like we always do. We'll talk about some sales trends with Sean. We'll talk about some rental trends and a current deal example that I close on tomorrow. And then what I'm super pumped about is Justin Shore sharing with us some knowledge from just his time in the real estate and tax profession. If you guys didn't hear some of the banter going back and forth, this guy loves digging into tax law and reading stories, i.e. case studies about how it's been applied in the past. And he's just a wealth of information. He comes from, I think, irrefutably the best known real estate tax firm that has been featured on Fortune 500, Bigger Pockets, a lot of places. And I'm just super excited for his time. So before we jump into this, I want to talk really quickly about a deal. And I'm gonna go deep into this deal later on, but to kind of like set Patrick up, I just want to talk about Warren Buffett and investing really quickly. Just some principles. The best way to win in investing is to buy like things of value at slight discounts and hold them for a long time. And this is Warren Buffett. You cannot time the market. If you try to time the market, you're going to lose. So in every market, you need to know how to look for valuable things. You need to be able to identify what their value is, come up with your purchase price, and then just buy quality assets that you're going to hold for a long time, because we think we can time the market. We think we know what's going on, but if you wait, you're going to lose. So you just got to know how to find things of value, buy them at a good price, and that's how you're going to win in investing. And Patrick, I think that sets you up really well for what you want to talk about.
Scott, first of all, thanks for having me. Appreciate it. I enjoy these quarterly knowledge that we get from these. So thanks for having me. So basically from the last time that we spoke, I want to show you a weekly average of what 30-year fixed rates have done. Okay, so last time that we spoke.
Actually, Patrick, real quick.
Yep.
We have a lot of new people on here. I want to introduce you.
Okay.
I should not take that for granted. Guys, Patrick Stoy is a phenomenal human being. He is a phenomenal entrepreneur. He owns a private lending company that helps investors buy things. And private equity lending company called MC Capital. And then he owns a mortgage company, MC Mortgage Group. So he can help an investor buy something that's uninhabitable, fix it up, and then get long-term financing on it so you can make money as you hold it for a long time. He is a real estate investor that owns very nice manufactured communities, and is just a great guy that I'm happy to be able to call my friend, and love that he's able to share information and knowledge so y'all can buy more properties and build your wealth.
Skylar, thank you for all that. Thank you so much. I'm blushing over here.
I could see.
But no, guys, again, Patrick Stoy, been doing this for 20-something plus years, going all the way through. My first deal was wholesaling a single wide, all the way up to developing a 52-unit manufactured housing neighborhood with all the little things you can do in between. So love helping people grow wealth through real estate to leave a legacy. It's kind of my tagline. So, but getting into what the rates are doing, things that we can't control, and where we are right now. So if you look here, starting back in July, coming into the summer months, the rates really peaked out here as time went on into October. is really the October, November time frame. After that, the Fed came out and said, we're not going to raise rates anymore. Things have stabilized a little bit in the market, so rates have started to come down. I would say that the worst is behind us now from a cost of borrowing standpoint. Okay, mortgage-backed securities, which move along more with the 10-year Treasury, not really what Prime is doing, have pulled under 4%, which is great. We hit 5.25 in the fall, basically, and we are now under 4%. So a lot of good stabilization of rates, which of course makes borrowing money cheaper. And we always like to leverage as much as we can at cost effective. So what this really boils down to is that we're in the perfect market right now, because what's going to happen as the rates continue to go down and stabilize, even if they become flat, the demand for housing is tremendous right now. And from an affordability standpoint, a lot of people are going to just get back into the market after the holidays, just because rates are now not above 8% where we were, and they're now down in basically the sixes. And again, I'm talking primary residence rates, but that's really our competition when we're buying properties as investment, is people looking for primary residences, because there's a lot of available products for primary residence people. Yes, Skylar?
Yeah, but Patrick, you can get a lower rate, and I'm not telling you this. I just want everybody to know. I'm closing on a house tomorrow at a 6.6% interest rate for an investment property.
Correct. And there are ways of doing that, which I think you're going to go through your case study with that. But I just want to give you guys, we're in a perfect opportunity. If you're looking to add to your portfolio, it's better. I would tell you that it's better to do it right now than to wait. Do you want to go ahead and go to the next slide there, Skylar? And all right. So guys, what I did is I put together a cost of waiting scenario, just to basically show that by waiting, and this is an example of somebody just buying a primary residence, and you can do the math. If I'm buying an investment property, it's $250. What does that look like? But really what it boils down to in this scenario here is that somebody buying a house today at $500,000 and the rate was 7%. By them waiting 3 years to try to buy that same house from a payment perspective, they will have lost over $80,000 in equity and principal reduction appreciation. So it just really shows you, with rates going down, even at lower rates, the property value itself is going to go up. So it's not going to change that payment that much in difference. Now, the good part about being investors is we hedge it for 30 years when we buy it, because we know that rents will go up as time goes along. So at the end of the day, it really is, the cost of waiting is going to really cost you some money if you don't take action on it sooner than later, because there is so much demand right now for housing that it's amazing to give up that equity, knowing that the sweet spot that we're in right now. It's just like knowing where rates were down in the threes 2 or 3 years ago, taking advantage of that, hedging those, that the amount of appreciation that's about to happen on properties due to the demand, especially here in the Carolinas, is going to be huge. So just the cost of waiting will cost you if you sit right now instead of take action.
For sure.
Yep, just showing through the basically the amount of appreciation for waiting period, of how much appreciation that, just say it was a 200, or this was a $500,000 example, that literally within 3 years the property itself is going to be pushing up to $570,000 in appreciation, because it compounds on top of itself as time goes along. And generally, and I'm sure Sean will touch base on how much appreciation is happening in this area in North Carolina, but normally the national average is about 5% per year. And as it compounds on top of itself, I mean, it really just is amazing how it can lead to, building generational wealth. Percentage of months to break even, and this was just showing based off of, 7% interest rates dropping down to 6%, and then the waiting period of paying for that over time, of how much forced appreciation that you're doing on the property. And this was just based off of not even having OPM, other people's money making the payment. This is just basically showing the payments over the 3-year time period.
So buying a good property, taking care of it.
Yep.
The equity game is going to take care of you. And if it's an investment, you buy it right. Hopefully it's cash flowing. So yeah.
Yep. 100%.
Cool. Great graphics.
They're stabilized, and the worst is behind us. So it's time to get on there and start buying these properties, doing these analysis. Do I want to grow my portfolio, and really doing that over the next, 6 months?
And everybody, I'll send this slideshow out. There's a link on this slide that is a Loom video of Patrick Stoy talking about all of this a little more in depth that you could kind of always reference if you wanted to.
Yep. It's about 4.5 minutes long, so I wasn't going to bore everybody with it here, but it does break it into detail. So if you have a specific question on, particular appreciation, because we do pull appreciation per markets of what it will do, and then build that out, the cost of waiting on that property, what the expected, ROI would be on that for a set period of time.
Yeah. And there's a lot of people on this call and that we manage for that have bought property this year. So I'm really excited because I hear people talk, no one specifically, about like, oh, you can't make money in this market. You can't buy something in this, like, you can't cash flow. And I just want all of this to like be encouragement that you just have to look. As Robert Kiyosaki says, you got to kiss a lot of frogs to find the right one. But like, yeah, the best time to plant a tree was 40 years ago. The second best time is
Today.
Right now.
Yep. Just some products that we offer, again, working everything from full doc, Fannie Freddie, getting the best rates, all the way up to, if you find a property that you want to come in and buy and flip, we'll put the money behind you to do that. We'll actually provide 100% financing up to 75% of the after repair value. So really just trying to put money behind people to help build wealth through real estate and leave a legacy. Bridge loans, we'll do ground up construction. We'll do DSCR loans, to where we don't get into your personal income. We just use the cash flow of the property to support the debt. You can do that with partnerships with people, makes it easy that way. Nobody's getting into everybody's personal finances. Nothing's being disclosed. We do true Airbnb properties. We run an Air DNA report to find out what that property is expected to do, or if there is a 12-month history on it, we will use that also. So we are using the true Airbnb numbers for that particular property. No ratio loans, or as if we're literally not looking at DSCR or Airbnb loans. It's really just an equity position loan. It's based off of your credit and the assets that are left over after closing. And then multifamily loans, we do anything from single family, duplexes, tris, quads, all the way up to apartment complexes. So anything that you've got, always like to have a conversation on it of what is the best way of either purchasing it and do a value add, and then rolling it out to some long-term financing from that perspective. So,
and I haven't bought an apartment yet, everybody, but if you want to, the amount of conversations I've had with Patrick, like, hey man, I want to buy this thing. Can you help me just think about it? Like, can I buy it? He is just a wealth of knowledge and helps you think through the problem set. So, Aiden said, is the no ratio for investment properties or primary residence?
So we have a no income verification loan for primary residences, actually. So we do have that on a primary residence, no income verification, but the no ratio is from a investor standpoint, that's for investment properties. So I have it for both if we don't want to verify income for the subject property.
Okay. Cool. Well, thank you.
Yep, no problem.
All right, so guys, moving on now to Sean McDonnell, one of my best friends, one of the best realtors I know, hands down the best investing realtor that I know. He's building a phenomenal team, has built a phenomenal team. His office is right across the hallway from me, if you can see me. And I'm excited to hear from Sean how he's going to share with us some national sales info and some local sales info. And so y'all can trust him. He's an active investor as well that has bought property this year and just continues to buy property to build a portfolio to get out of the rat race and retire on. So Sean, over to you, man.
Thanks, Skyler. Thanks for the kind words. Yeah, so we're in this weird time where, prices are continuing to rise amidst kind of all the talk and the economic uncertainty. And here's just some stats nationally, but coastal North Carolina continues to like outperform the national price increases. But you can see here, average sale price as of last month, 515,000. This is nationally up 5% from this time last year. And these are year-over-year statistics or year-to-date. And the number of transactions is down 14%. So generally, there's a significantly lower inventory in most markets across the country, and we're definitely seeing that too. You can see these two quotes from the chief economist at the National Association of Realtors, and I just resonate a lot with this, where first-time homebuyer price ranges really under 300,000 here. Houses are selling very quickly still if they're in decent condition and priced well. And then once you get over that, once you get it, especially $400,000 or $500,000 price range and up, they're sitting a lot longer. And there's every Monday I get on the MLS and just look at the price drops and see, I see so many price drops these days from what I'm used to over the past couple of years. But still prices are continuing to go up. So I included some graphs in the next slide. The three major counties that I know Cedar Ridge manages in, and we do sales in: New Hanover County, so this is the greater Wilmington area. You can see the top chart is the average sale price, up 7.1%. The average is actually at 535,000 almost. But you can see the number of new listings has just declined over the past 2 years, down 15%. And then if you go to the next slide.
Real Sean, if I could extrapolate a little bit from that, new listings down and speak into this if you want to, means less people are moving.
Yeah, absolutely. I think less, especially maybe in those situations that typically someone would want to either upgrade or downgrade, if they have a kid and want a bigger house, or become empty nesters and want to, sell and get a smaller house. A lot of those situations I'm seeing, people are just like hanging tight for now because they want to wait to kind of see what happens. But definitely way less people moving from what we can see. And then this is continuing through the next two slides. Pender County, very similar to Onslow County, or very similar to New Hanover County. Sorry, Pender County is much smaller than New Hanover County, but around a 5% increase in prices from last year, and about a 17% decrease in inventory, new listings hitting the market. And then Onslow County is pretty crazy. It's over 10% increase in prices. Onslow County just broke into the $300,000 range, but almost a 50% decrease in the number of new listings from this time last year. Which I think is adding to, the supply is dropped significantly. And even though the demand has also dropped a little bit, it's still, not enough to lower the average sale prices. But yeah, we love digging into the data, and we love getting into the weeds with people's situations. Sorry, Skylar, I meant to delete that slide. You can skip that one. But overall, we love getting into each person's situation. I think strategies that we're seeing are super effective right now is house hacking. If you live in a primary residence where you can rent it out, we think, that is a really good strategy that's working now. And then, just trying to dig into your goals and see what could be feasible. Please reach out if you have any questions for us, but that is all I have. Thanks, Skylar.
Yeah, Sean, thank you for sharing. It's always neat to see how sales and rentals kind of affect each other. So, what's up, Michael? You got a question? Michael Freelander? No? Okay. Well, when you unmute yourself, or if the question comes back, let us know. So what is going on a rental scale? So we are seeing a huge slowdown, and rent prices on just a national scale are dipping a little bit. I think something that was really cool, or maybe interesting is a better word. Where was it, Sean? Yeah, right here. So highest mortgage rates in a generation. So we're all coming off of as investors, like the most recent experience that we have, this last generation, if you will, is things renting quickly and us raising rents. It's just like, that's been what we've felt over the last 10 years. And we're no longer in a market like that on a national level, and definitely on a local level. And I'll get into that. But as you can see here from Redfin, all of the building boom that started pre-COVID, that was delayed during COVID, has come on the market and is coming on the market and has really blown up the supply with less people moving around because the cost of living has increased and wages haven't caught up with the cost of living increases, which means you have a lot of rental supply with less demand, and it's bringing the numbers down. You can see asking rents had the biggest decline in over 3 years in November of 23 on a national level. And this is just more data backing that up. But again, like, not all doomsday talk, right? Rents are still higher than they were pre-COVID. So the dip we're seeing isn't like a drastic dip, everything's fallen through. It's just a dip in the experience that we've had, but rents are still appreciating it. I would say slightly above all of the inflation that everybody's felt, and definitely way ahead of wages and other things that are affected well after inflation hits. So we're still moving in the right direction, but like the very close to the boat feeling that we have as investors, and definitely that I have as managers, is such a longer time on market to get things rented. So specifically to places around the base here, we're seeing a ton of supply. When I built this slide on Monday, there were 38 3-bedroom, 2-bathroom homes in Sneads Ferry alone that were available for rent. It's just unheard of in the last 10 years since I moved here. The average days on market for things are in Onslow County 67 days. This is listed for rent on the MLS from the time it was listed to the time there's a signed lease and move-in funds collected. 67 days in Onslow County. Pender County, 22 days, and New Hanover County, 65 days. So why are these dates so long? One, supply and demand, but two, investors are greedy right now, right? Warren Buffett says that, like, I'm losing a quote right now because I need the information, but greedy investors lose. So if you're expecting to get a rent that you got last year, if you're expecting I'm going to buy this thing and rents are just going to increase, and that's the position you want to take, you're going to lose because you're going to be listed for a long time. But if you undercut the market right now, if we undercut the market and we have a good product that we put at a fair price, slightly below stuff, we're going to be able to beat that, and we're going to be able to win on the long term. So Michael Freelander, can you unmute yourself? Do you have a question?
Yes, I did. Can you hear me?
Yeah.
Okay. Hey, a couple quick notes. One, I've got a relative that has a long-term rental in Onslow, and yeah, he was my dad actually, and his place was on the market as far as for new rental for about 40 days. which
Yeah.
and actually he didn't go up. He really couldn't go up. He was able to, well, went down like $10. So what's $10? Nothing. So
Yeah.
yeah. But hey, where I was going with this more on the short-term rental market, because obviously that's where I'm focused. And what I'm hearing is that with the decrease in the rental rates, because people aren't getting what they got before, and all it takes is a couple of people to lower their rates. And if you're like me, if you're second row and the first row to the beach, if they drop it, you got to do the same thing. So with people having bought at a nice price for beach property and not bringing in the rental income that they wanted, I've been told there's a lot of people that are actually selling, that when they can't pay their mortgage, they're listing their property, they're selling, and they're selling at a reduced price because they need to get out from under it. Are you seeing any of that?
In the short-term space, because we don't really manage that. I couldn't speak to that, but and Justin would be able to speak to this, but I'm going to show my hand here a little bit in my tax knowledge. If you've lived in something as a primary residence in 2 of the last 5 years and you're hurting from an investment standpoint, it would be extremely wise to sell it so you don't have to pay any capital gains on it until that situation no longer applies to you. And maybe Justin could speak to that, or we can handle it in Q&A. But Justin, if you got a quick answer to that.
Yeah, I would just comment to Michael's questions there. I think there are going to be some opportunities that present themselves because there were a lot of I would say newer investors that were jumping on short-term rentals in those markets or whatnot, and maybe weren't like seasoned operators. I think that in the next couple of years, it's going to really prove the difference between really, really good operators that are able to focus on making their rentals stand out better than others. They're still going to be able to get those higher rental rates and everything. But to Skylar's comments, there's a lot of different ways you can slice that. So it's definitely, it depends type of answer. But yeah, there's potential way to tap into tax-free capital gains by whether or not your property was a personal residence at some point in time. But definitely depends on whether it was rental first, personal residence first, that sort of stuff.
Mm-hmm. Sweet. Yeah. Operations is how you're going to stand out in this market. That's a great answer. And something that I didn't think about, Michael, when you asked that question, we are onboarding right now a lot of properties that were short-term rentals, that people that bought to short-term rental, and it wasn't as lucrative as they thought it was going to be. So they just decided that, what the heck, this is, I'm not going to make what I thought I was going to make, but at least it's going to be taken care of well. And I'm going to break even with my mortgage payment if I recently bought it or bought it last year with a higher interest rate. So I'm seeing a lot of that. People turning short-term rentals that aren't beachfronts or big beach properties, but are the furnished office traveling nurse thing that they thought was going to take off that didn't. We're onboarding product like that right now.
Are you saying from a rental perspective or from a purchase perspective?
From a rental perspective, people are coming to me and saying, Skylar, this isn't working out as a short term. What would I get for rents long term? And talk to me about what that looks like.
Okay. Thanks. Appreciate it.
Yeah, you're welcome. So what are rates right now? Rental rates doing right now? In Jacksonville for a 2-bed, 1-bath, since the last time we talked, they're about the same. They're $10.50 for a 3-bed, 2-bath, no change. Y'all can see the numbers up there. Something that I'm really excited to talk about is what's going on with Section 8 housing. So y'all can see this, and if you have any questions about rates, let me know. But what I'm really excited about is the Section 8 increase for MSA Jacksonville, which is basically Onslow County. The 3-bed scenario on October 1st of 2024, Section 8 will be paying out a fair market rent of up to $17.95 for 3-bedroom houses. and it's currently at 1352. So what does that mean for us? Knowing this information, that means there's a buying opportunity to capture kind of like the 1% rule that everybody's read about and has been like this unicorn for the last couple of years. Like, oh my gosh, there's no way you can find a 1% rule. Well, I am closing tomorrow on a house that meets the 1% rule because of the Section 8 rule. So in that research project for me to buy something, I looked at a lot of houses between the 180, 220 price range that were rent ready with tenants in place or would have been turnkey without tenants, that would require no work, that you could cash flow almost immediately, but definitely once you raise rates to 17.95, or I would raise rates for you to 17.95. So this is my investment worksheet snapshot that I wanted to provide to you guys, is like a what's happening right now. And I'm under the gun. I want to give it to Justin here real quickly. So I'm buying a house for $180,000, or $177 after my seller credits. It's gonna not cash flow very well until I raise rents in October, but then I'm gonna be looking at about $7,000 a year in cash flow from this one property that I'm buying for $180,000. It's just a phenomenal deal that there's a lot of them out there. And if you want to know more about that, let's talk offline and let's connect you with Sean and his team, and let's start building some more wealth. You guys are already doing it, so let's just continue it. But what I'm most excited for is Justin Shore to talk to you about tax strategies. And I'll just give it over to him. I've talked enough. Justin.
Yeah. Thanks again for having me, Skylar. So like you said, really briefly at the beginning, our firm specifically works with real estate investors primarily. And a lot of our clients, have some kind of, maybe another business or W-2 job or something along those lines. We take care of that stuff sort of, on the side as well. Our primary focus is working with investors like yourselves to figure out what kind of tax strategies are available to you, and what things actually will work for you in your personal situation. Because like today we'll hit something from kind of like a high level. Always just have to preface it with everybody's situation is extremely unique, and figuring out how the various strategies in real estate are going to apply to your specific situation, your specific portfolio, and your goals just as a whole is always going to be very unique. So we can go ahead and jump into it, and we'll give you a kind of a crash course here real fast. So I had some animations on here. Go ahead, I give it a couple. Yeah. So essentially what we're always dealing with real estate here is you've got two different buckets of income. Like all income gets categorized into these two sections of non-passive versus passive. Non-passive being like what you would expect, like W-2 income, business income, like if you have, an active trader business that you're operating, whether like you're a real estate agent or, you run an HVAC business, something like that, it's going to be on the left side of the fence here. The right side of the fence being passive, which by default is going to be all rental real estate. You can have passive investments in other businesses as well. That would be like if a friend of yours came to you and said, hey, I need some seed capital to get this business off the ground, but you're not really actively participating in it like on a day-to-day basis. But the main thing that we're typically dealing with real estate is, one, we want to generate tax losses if we can, for obvious reasons, reducing our just taxable income as a whole. And I'll kind of get into like why we're talking about losses, because I know so far we've been talking about properties breaking even, making a little bit extra money in year 2, year 3. But I'll kind of talk about how we can do this, what we would do, or what we would say is a paper loss, where you're cash flow positive, tax reporting negative, essentially. So kind of talk about how to actually do that here in a bit. But the dilemma here, why we call it a dilemma, is with rental real estate, since it falls into this passive bucket, in order to use losses from rentals to reduce your W-2 and other business income, you have to meet one of the exceptions to the rule. And the main exception that we're going to talk about today is being either you or a spouse qualifying for real estate professional status. And if we're able to use something like real estate professional status and follow a few of the other guidelines, then you can treat your losses as non-passive and start offsetting your other sources of income to generate those large tax refunds. So in order to do this, I can see there, it takes 750 hours in a real property trade, which when you look at that, it's like, okay, that's not too bad. It's not a full-time job. It's roughly 15 hours a week if you're looking at it that way. But the other hitch is it's got to be more than half your working time. So this particular strategy doesn't work for investors that are working like a full-time job that's in something that's non-real estate related. So that's where it can be really handy. Like if you have a spouse, like if you're working a full-time job and something that's completely unrelated to real estate, but you have a spouse that's able to do that, you can, I always like to say, piggyback off of your spouse's status as a real estate professional. Now that's just step one. Step two there is you do still have to materially participate in your rentals. Effectively what that means is you've got to be actively involved in the day-to-day like trader business that is your rental activities. So
So
typically,
you gotta fire me.
yeah, right, exactly. Yeah, typically if you have a property manager involved, it's going to preclude you from being able to say you're materially participating because your property manager is, you know, like Skylar in this case, is going to be doing most of the work on the day-to-day operations for you. That being said, there are ways in some fashions, depending on the size of your portfolio, that you can have property managers involved and still be able to hit material participation. Again, that's just one of the many like things we have to dissect when looking at, you know, taxpayer situations, is whether or not they'll still be able to hit this. The reason why there's so many different numbers on here too is the 750 hour cap, that minimum that you have to hit. It is hours. It does have to be hours that are considered material participation hours. But the reason why there's these lower thresholds, like 500 hours, 100 hours, is you could have multiple different types of activities, like multiple trades or businesses in order to qualify as a real estate professional. Just an easy example, if you are a real estate agent, you're spending 1,200 hours, 1,400 hours a year in that job, you're going to qualify as a real estate professional, but you do still have to separately meet that material participation test, like on your rental properties, even if you're hitting real estate professional status without your rentals. Now this is just some like a kind of a high level overview of a lot of like examples of what's considered material participation. As you can probably imagine, like the IRS has their own definitions for a lot of words that deviate from Merriam-Webster's definition. So we always have to be very careful of figuring out like what the heck do they mean when they say materially participate in your rental properties. You kind of see here a lot of this is like, you know, talking to tenants, screening tenants, handling repairs and maintenance. The middle section in there is probably the more confusing of the grouping. That's all the time like related to your acquisitions. Of actually, you know, once you get under contract and you're going through the motions of having inspections done, maybe renegotiating for seller credits when you find some kind of defect of the property, stuff like that. The key here with this though is that if you're wanting to like utilize this strategy to treat your rental losses as non-passive and like offset W-2 income or business income, you've got to keep a record of all this time that you're spending, because since it is a very specific black and white threshold that you have to meet, it's typically the very first thing that an auditor will ask for, is they'll say, show me the documentation, the substantiation for the amount of hours that you're spending in your rental business. So we highly encourage all of our clients. In fact, if we're filing tax returns for clients like using real estate professional status, we require that they give us a copy of their time log that they've kept, because we won't take the position on a tax return if they don't have it documented, because we know you'll absolutely lose in an audit if you don't have it documented.
And you know that because you read all these case studies.
Exactly. Yeah. And there's actually, surprisingly, it's funny how the IRS is very transparent with some things and less with others. But they actually have their audit manual that they provide to their auditors. So it's like their employee handbook basically on how they're supposed to attack this. It's publicly accessible. So like I actually have a copy of it sitting on my desk right here, printed out. But it literally tells their auditors like how they should pick this kind of stuff apart in order to be able to win the case against the taxpayer. So very, very important stuff. And we get a ton of questions on this, I would say, on a regular basis for sure. So So that's kind of quick high level overview, real estate professional status and material
Can we go next?
certification. We'll kind of jump over here before, like I said before, we're talking about losses. Why are we talking about losses? I don't plan on losing money with my rentals. Well, one of the biggest ways that we can generate these tax losses without having operational losses is by accelerating depreciation. That schedule there, the bonus depreciation rates, that's what they are currently, just under the current laws. Like if you have a property that you place in service in 2023, you get 80% bonus depreciation for it. Next year is an election year. We already know there's been a lot of grumblings about this. We'll see how politics develop around this, but they tried to change it last fall. And then a lot of stuff like happened over in the Middle East and everything kind of distracted from tax policy. So that is something that is brought up pretty regularly in Congress, though, as far as, so it's always worth like keeping an eye on because we see it change pretty often. So for the most part, we get the question a lot of like, is this something that's going to be beneficial for me? Should I do the study? My last CPA told me not to. All kinds of like misconceptions float around out there. In most cases, it's going to be beneficial as long as your property is above this kind of minimum purchase price and of $150,000, which is hard to find a property for less than $150 these days, anyways. But a lot of that it just has to do with cost and benefit. Cost segregation studies cost you money to have them performed. So kind of the cheaper the property is, the less like benefit you'll have from that. Some states don't recognize bonus depreciation. North Carolina, South Carolina actually happen to be a couple of those states. A lot of times it's concerning for folks, but what that means is the state won't allow you to take it, but you can still take it on your federal tax return. And your federal return is typically 5 to 8 times higher as far as tax rates go than at the state level. So it's not too much of a concern at the state level.
If you guys want to do a cost segregation study, I just put a link in the chat message that I talked to Justin about. Could you talk maybe about how to do that?
Yeah, absolutely. Let's go ahead and jump to the next slide. I'll kind of talk about like mechanics and stuff like that on here too. So you definitely want to have a qualified professional perform the study for you. It's your tax preparer cannot do it for you. If they tell you that they can, run the other way. You definitely want to have a cost seg firm doing this. It's an engineering kind of professional sort of trade. So you don't want to rely on your tax preparer to be doing these for you or making any kind of ballpark estimates. Now, part of the reason why we want to do this is, yes, we want to do it for bonus depreciation because it means we can take a huge write-off in the first year from the acquisition. But just in general, it's helping us get faster depreciation across the board because if you're dealing with a traditional long-term rental, the building is depreciated over 27.5 years, which is very slow. It's about 3.6%. The cost segregation study is going to identify the 5-year and 15-year class lives of pieces of the building. So IRS concedes that there's parts of the property that don't last 27.5 years. All that being said, their categories don't make a lot of logical sense. Again, it's kind of like their definition thing doesn't make a lot of sense sometimes. I'll just give you a quick example. A refrigerator, they say, is 5-year property. That's actually really good for us because we know that it's probably going to last a lot longer than that, hopefully, as investors, but we can depreciate it over 5 years. And there's a lot of similar types of things like that in both of those categories. And we consult on that a lot. But main point here being is that when you're looking at bonus depreciation, you can only take bonus depreciation on assets that have a life of 20 years or less. So this 5 and 15-year property that gets identified by the cost seg study is really key because that's going to be what we can take that massive acceleration on. And that bonus depreciation rates we had on the previous slide, 100%, 80%. Again, that's based off of when you place the property into service. Effectively, like in 2023 being 80%, in this case, you'd be able to take 80% of the 5-year and 15-year property as a deduction, as accelerated depreciation on your tax return. And that's going to be a big component that allows you to generate these tax losses as opposed to operating losses. So I think I threw an example in there for you if we can kind of just hit that really fast.
Yes.
So we do always have to break out the land value because land is not depreciable at all. So that is something to kind of keep an eye out for. Like somebody earlier mentioned, like beachfront type properties and stuff. The closer you get to something like the beach, the higher the land value is going to be. Now, nationally, we see like an 80-20 split is pretty much the average. I see like when you start getting closer to something like the beach, you're going to start seeing like 40%, 50% land values, where you've got less value in the building, which that of course is going to bring the results of your cost seg study down naturally. So that's just something to keep an eye out for. But this is just kind of a general example. Like I said, rough estimate for like cost seg results would be about 25% of that building value being 5 and 15-year property. So you get to the 100,000. If this was a 2023 acquisition, we take 80% bonus and get to $80,000. And then we do have to remember, like, these are deductions that we're talking about. So like an extra $80,000 in deductions, if you were in the 35% tax bracket, it's going to end up resulting in about $28,000 of tax savings. Again, all that being said, is kind of a high level example, but kind of gives you like a good kind of back of the napkin sort of, you know, estimate on like what the results of your cost segregation study can actually generate.
Sweet. And could you give an example, or maybe I could give an example, and you corrected, of how people are using this? I love the spouse Batman Robin combo, because I was in the Marine Corps for a long time. Yeah, and my wife was the everything for that, even though I had the W-2 paycheck that was qualifying us for loans.
Yeah. So like I would say like I always say like the best way, but like probably the best example is, yeah, you've got one spouse that is not in real estate, you know, W-2 earner, maybe making, you know, $300,000 or something like that. Definitely can't qualify for real estate professional status because they're working, you know, 40-hour week in, you know, non-real estate trade. And you have the other spouse picks up, you know, heavy real estate investing activities. Maybe they're doing some flips, maybe they're a real estate agent, and then they're also like handling, you know, rental properties that they're acquiring. That's a really good combo, because essentially you've got the one spouse that's qualifying for real estate professional status to generate these losses with real estate. And then that's taking huge bites out of the other spouse's W-2 income. And, you know, with a W-2, you've always got money that's being taken out for taxes, right? Like that's essentially, you have estimated payments going to the IRS every 2 weeks when you have a W-2 paycheck. But if you have the spouse over here generating non-passive losses with reps, when you go to actually file your tax return, at the end of the day, you're going to have a much lower adjusted gross income than like the W-2 employer originally, you know, planned on you having, because they had no idea that you're doing all this stuff with real estate. So then when you go to file your return, your W-2 income has you overpaid significantly, because you've got these losses offsetting the W-2 income. And then that's where you end up generating those big refunds. So
Sweet. And then that's more money to buy more properties with.
Yep, exactly. And then you can effectively rinse and repeat.
And I think you see people do this a lot in the short-term space, because it's easier. This might be wrong, but I know there's people on this call that have both long-term and short-term stuff, and they like me managing the long-term, but then they qualify and depreciate the short-term thing, because typically that's a lot more depreciation to capture, because a short-term property is going to be like 750,000, 400 or 500, like your example here, and you're going to be able to shelter or hide more money because of these phantom losses.
Yeah, exactly. The short-term rental, we would like often call it the exception, because the exception to the rule, and that you don't need to be a real estate professional if you're using short-term rentals. There's a whole separate set of rules to qualify for that. But a lot of people refer to it as short-term rental loophole, so to speak. I don't know if I'd necessarily call it a loophole per se, right? It sounds more catchy that way. But yeah, you effectively have the same end result, is the short-term rental can generate these non-passive losses. And it's a lower threshold to hit, because you don't need 750 hours. You just need to have material participation in the property, which could be as little as 100 hours instead of 750. So we have a lot of clients that maybe don't have the long-term rental portfolio size that's like big enough to be able to support getting 750 hours. Or if people are just not interested in other real property trades, like flipping, wholesaling, being a real estate agent, being a property manager, doing construction, you know, if they're not interested in any of those other types of areas, then short-term rentals are a good like alternative in that.
Okay.
In that case. But
Justin, we got a couple questions in from Aiden. Is cost segregation only applicable for a property purchased in the calendar year?
That's a really good question. Short answer is no. So you can, one, if you can get a cost segregation study done after the end of the year you buy the property, it does not, a lot of salespeople tell you have to get it done by the end of the year because they want to hit their quotas. But but you absolutely can have it done after the end of the year. So if you're like, oh, I just found out about this now and the cost seg firm is telling you they can't get it done for 6 weeks, that's totally fine. You just have to have it done before you file your tax return. So if you're filing an extension, then you technically would have as late as October 15th next year. Not that you would want to wait that long. But now the other way I'm kind of reading that question is like, what if you bought a property in like 2021, 2022? And now we're like filing the return for the property. Now that we've had it for like 2 or 3 years, can we do it now? Answer on that is yes. It's a longer answer. And there's some additional forms that you have to file with your tax return to be able to do that. I've only met 1 or 2 other, like outside of our firm, I've only met a couple of people in all my dealings that actually knew how to fill out that form. So it's a form 3115. If you're talking to like a local CPA or something like that, and you say, hey, can I cost seg my property I bought in 2021? And you're just kind of wanting to like qualify them to see if they know what in the world they're talking about. You can just ask like, yeah, what special things do I need to do for it? 1, they should tell you need to get a cost seg study by a reputable firm. But 2, they should tell you it's going to probably, their fees for preparing your tax return are going to be higher because they have to file 3115. They don't bring anything up about that. I would say, okay, thanks. Nice talking to you, and maybe go find somebody that knows how to do it. But that is critical. You got to have that form 3115. If you're doing it in like a later year, you don't have to do that if you're doing it in the first year.
Okay. Sweet. Thanks. We got another, or Aiden, did that answer your question? Silences.
Hopefully it didn't just make it more confusing.
Yeah. Yep. Perfect. Thanks. So we got another question in. What if both are in retirement from a W-2 job and receiving pensions?
Yeah, that's a great question. So, so if you're retired, you don't have like another, like a W-2 job or a business that you're working in that tax year. So when it comes to something like real estate professional status, you could do it. Because the second part of that, I kind of skimmed over quickly, is you got to have that 750 hours and more than half your working time during the year has to be in real estate. That's a hitch for people that have some kind of job that's outside of real estate. So the one benefit you would have there is that you don't have to worry about, is my W-2 getting in the way? Like, I just need to focus on 750 hours. All that being said, it is still beneficial to pursue something like reps if you're in retirement, because like pension income and IRA distributions, 401k distributions, all that kind of stuff, that income is considered to be non-passive income because the origins of where it came from was from a non-passive activity, i.e. your past employment. So like if you're wanting to offset pension income, 401k distribution income, stuff like that, you would need something like either real estate professional status or to execute the short-term rental exception strategy, 1 of the 2.
Did that answer your question, Rima and Dennis?
Yes, it does, Collier. Thank you both, Justin, for verifying that.
Yeah, you're welcome.
I'll caveat a lot of that just to say, like, too, I mean, sometimes I will have people hear some of the stuff and realize I didn't realize there was so much work involved or all these exceptions and rules. Like, what if I don't want to do that? Like, are you telling me that stuff like cost segregation studies aren't going to benefit me, or that, I can't take these losses? There's still a ton of benefit in having the cost segregation studies done. It's the strategy shift a little bit. You have to kind of pivot into like looking at it through a different lens. But for me, for example, I've been investing in real estate for almost 9 years now, I think. And I'm not a real estate professional because unfortunately, like consulting with real estate investors does not qualify because I do all this tax stuff. I still have cost segs done on my long-term rentals. So it just, again, to each their own as far as like how you want to tap into the different strategies. This is more powerful though.
Money now is more valuable than money later.
Exactly.
So real quick, I want to open it up for questions, but I kind of want to share with you something I'm learning and how Justin is an answer to that. I have been using CPAs wrong, and I haven't known how to like think about a CPA. You read these books about getting a tax advisor in your corner, a wealth building advisor in your corner. And so I've gone on this journey, and I've been so unhappy with all of my accountants because I'm using them incorrectly, and I'm not even knowing what questions to ask them to see if I should be using them a different way. And Justin's such a breath of fresh air because he starts the conversation with you with, hey, there's this like advisor fee, right? We're just going to talk to you about planning, and there's a fee associated with it. You're going to pay me to help you plan. And then there's tax preparation, and they're two completely separate things. And if you need tax advice, if you actually, like I read this book and they talk about planning, Skylar talks about planning, all these people talk about planning. What the heck does that mean? Schedule a call with Justin, and he will help you come up with a tax plan. Like, just, I can't say that enough. If I had found Justin years ago, I wouldn't have as many headaches as I do now.
Yeah, there's definitely a lot, and that's where we know just there's tons of value in the planning. There's definitely like a right way and a wrong way to file tax returns. You know, that's part of it. You know, and having the knowledge and expertise like on real estate specifically, there's a lot of subtle nuances there, but a lot of the real estate related strategies, they require involvement on your part. So that's a big thing is, and especially like doing things, you know, earlier in the year rather than later is always helpful, because then, you know, you've got plenty of time to actually execute. If there's, you know, 3, 4, 5 steps you got to take, it's always better to know, oh, okay, great. I got a lot of work to do, but I've got 9 or 10 months to do it. So it's always more beneficial that way. And sometimes there's just so many subtle nuances with the tax code, especially with real estate, that, you know, even if there's like pitfalls, we can help you navigate to get around some of that stuff. That's a huge thing of what our advisors do. And a lot of that's like what Skylar was saying is we get that comment from people all the time that I don't know what questions to ask. That's the beauty of all of our advisors. And that's my main role there is I train all the advisors and meet with them on a daily basis on all kinds of scenarios and stuff, is hearing what you as the investor is actually doing and what you're trying to accomplish, like what your goals are, what kind of assets it is that you're interested in. And then they take all that like knowledge they have to go, okay, this is what you need to know. So even if you're not entirely sure what all the questions are that you need to ask, that's where like our skill set really comes into play, is helping you go, okay, we know all the stuff you don't know, but we'll hit you with all the, like based on what you're trying to do, we're going to give you all the information that you need to know to be successful and be tax smart with all your investments. So I don't think I sent over the slide that has our contact info on there, did I? I think somebody posted that in here. Is that something we can easily distribute?
Yeah, for sure. I can, I'll send it out to everybody. And if we can put it in this chat, I can drop in the become a client link if you want. Whatever.
Yeah,
you want
I'll drop a link in here really quick too. So this one, you guys, we put a ton of content out for free as well. I'd definitely check out, whether you're a seasoned investor or you're new, check out our podcast. It's hugely informative. And it's called the Tax Smart REI podcast. I mean, you could probably search for the Real Estate CPA, and that's actually how I found these guys years ago before I started working for the firm. That link I just dropped in the chat box, that'll take you to my landing page. Just gives you a real quick overview, of the firm and stuff. We have a ton of resources there on the website as well that you can access. We also have an internal forum that you can join as well, but there you can also become a client, a full-fledged client. We do tax preparation and accounting services, kind of the full gambit of things here too. Rima said, I live in Hawaii with property in North Carolina. Yes, absolutely. We have clients in all 50 states. So we're a virtual CPA firm. So our staff's actually spread out all over the country. At this point, we've had clients in all 50 states, including, I was just talking to one of my clients in Hawaii 3 weeks ago. So no state that we're not familiar with at this point.
Justin, I got another question in. I think he's still on the call. He actually emailed it to me today. So when I told you, is there a need for you? 100%. He said, so he's an officer in the Marine Corps. He doesn't think he needs like a CPA or somebody like you because he just has a W-2 and one long-term rental. But he's concerned that because of his promotion and the income that he's going to get from his long-term, that he's going to bump up into a higher tax bracket. He doesn't want to pay more taxes than he has to. Is that the type of situation that you'd be able to help with?
Yeah, absolutely. You know, even if you have like a limited, you know, like a smaller portfolio or something like that, we have options for that. I will say, you know, our one-on-one advisory services are very intensive. You get a lot of, you know, upfront planning and a very one-on-one type of attention. A lot of people don't need that though. They don't need, you know, they don't need to kill the fly with a bazooka, so to speak. So that's why we spun up our internal members forum. And it's perfect for clients that are like more of that size because our internal forum, it is like a subscription-based model. Like instead of paying a fee and signing up for like a 1-year plan with our advisory services, you can join that group. And the internal forum is overseen by one of the partners, and then all of the guys on my advisory team are in there answering questions for clients every day in the forum. And then there's a whole bunch of resources inside of that forum as well. There's like tools and templates that we provide everybody in there. There's master classes that are held on a regular basis. We just had a live Q&A today that I was hosting with one of the partners for all the members in that group, where people are throwing out kind of like what we're doing right now, just a bunch of you know, one-off questions. So I'd say that's pretty good like resource. That's called Tax Smart Insiders is the name of our group. You can find that on our website as well to build it. And you can do we do like a 30-day free trial. So I definitely encourage everybody to check that out. Pop in there, do the 30-day free trial, see if it's helpful to you, and see if you want to get have access to somebody that's a real estate specialist. Even if you're planning on self-filing on TurboTax or you know, using local CPA for filing, but you just kind of want a little bit more of that access to somebody that can do planning with you on an occasional basis.
Yeah, I cannot recommend Justin's services enough, y'all.
Yeah, I appreciate that.
Yeah. Well, does anybody else have any other questions? Chris.
Thank you for the spotlight. How's it going, Justin? Chris Bush. I realized after talking to you how much I don't know about taxes, so thank you so much for all the information. It's definitely eye-opening. I have a specific question for 1031 exchanges.
Sure.
I reached out to a 1031 title exchange company and a couple of them, and I have kind of conflicting information, specifically for if someone was to sell a property and roll it into a new property. To my understanding, 45 days, 180 days for timeframes, and then also the new property has to be more expensive than the old one. That's my understanding, and I guess where the question is, I've heard two different answers. Do you have to replace the debt from the old property into the new property? So, for example, I sell my I sell a $300,000 house. I owe $200,000. Do I have to have $200,000 worth of debt on the new property?
So not exactly, not technically. So you've got to replace the value of the debt. So that's where like most people will simplify that to say like you've got to 1031 into a property of equal or greater value. So and what I mean by that is like in your example, if you had $200,000 of debt on the relinquished property, you maybe go into the replacement property. We'll just say it's a horizontal, like you sell for 300, you buy for 300. If you only say you take on a lower debt load, like $150,000 debt, like mortgage for that $300,000 replacement property, that's fine. It just means you got to bring extra cash into the deal, essentially. So, you know, extreme example of that, you could bring a lot of extra cash into the deal and not replace any of the debt. So the problem arises if you were to go the other direction. If you did a sold for 300, bought for 300, and you had 200,000 of debt on the original property, but because you've got a lot of equity that's going into the new one, you could get like a new 80% LTV. So maybe you're 240,000 on the replacement. What's going to happen there is you're able to pull $40,000 of cash out of the deal. If that happens, you go too high, like you go up in debt without also going up in value, that $40,000 difference would be taxable. That would be what they refer to as boot. So, yeah.
I understand. So just to make sure, go ahead.
So that's where a lot of the confusion comes from, though, is like the idea that because in a traditional situation, yeah, you've got to roll all the cash into the next deal, and you've also got to have an equal to or greater amount of debt. But what they're really driving at is that you're replacing the value of the debt, because they're just assuming in most 1031s you're probably not going to bring more cash into the next deal.
Understood. Okay, sweet. Thank you so much. That clears it up.
Cool. Awesome. Yep. Yeah, the 1031s can be particularly tricky. And just make sure QI hangs on to the funds throughout the whole process.
Awesome. Thank you.
Cool.
Mhm.
That's a great question, Chris.
Mhm.
Anybody else have anything? No? Well, Merry Christmas, everybody. Thanks so much for joining us. Yeah, really appreciate it. I will send out Justin's contact info and the slides and the recording tomorrow morning once the recording's done being processed.
Sounds good.
Yeah, Justin, do you have anything you want to impart on us before we take off?
No, I mean, just I know it's like self-serving for us to say. I'd say, this is a great time to start, just like thinking about that, considering 2024 plans and stuff like that, especially with the ever-changing landscape. Politics constantly changing tax code on us and stuff like that. But I have a lot of people right now. They're asking like, well, does it make sense for me to start because I kind of missed the boat on 2023? I'd say absolutely. Starting in like February and March for working on tax planning. It's much less stressful if you're doing it like in the first half of the year. Because like I said, a lot of what one of the things that we do if you do sign on to be an advisory client is we literally give you a roadmap of all the various strategies that are the most hard hitting for you. But we also give you action steps on this is what you got to do before the end of the year. So we do give you a bit of homework there, so to speak, but it's a lot easier to work on that stuff throughout the year. To get it all accomplished before December. And also that's what your advisor stays in touch with you throughout the year to give you support. So when you say, you know what, you told me this stuff 3 months ago, but I forgot half of it. I need to jump on the phone and get a refresher. That's exactly what we do. But yeah, I'd love to talk to you guys. We have a lot of folks in North Carolina that are clients already. It's actually where we have, I think 4 or 5 staff members. That's where our founder is from. He's from Raleigh, so that's kind of his neck of the woods. But love to see you guys in the ecosystem soon.
Cool. Well, thanks again.
Yep, my pleasure.
Merry Christmas, everybody. I'm signing off. Call me if you want to.
Merry Christmas.